In this video, we are going to talk about the basics of the NPV rule for capital budgeting. The NPV rule is a rule that you can use to decide upon what capital projects make good investments and to make a decision on what investments to put your money into. Now, the way that I'll illustrate how NPV works is to take a look at three projects. All of them are a project where you're reconditioning, say, a space for some sales, for example, a snack bar at the Carver Hawkeye Arena. And I'll do all of this in thousands. So investments A, B, and C cost $1, $2, or $3 million. And investment A is a temporary location. It'll return you $1 million in a year, and then you'll have to abandon that location. B and C will last for 5 years each. C has a larger capacity. So if we have a NCAA championship year and Carver Hawkeye sells out, then you'll have higher revenue in, say, year 3 for each of these, but the revenue for location C is much higher than B. And what we're going to do is talk about how NPV can be used to calculate the value of each of these rules. The basic formula for NPV is you take each of the future cash flows on the date that it occurs, divide it by 1 plus interest to account for the cost of borrowing and the time value of money, discount it back to today, and add them up. Then you subtract today's cost. Well, the signing of the cash flow conventions is that a cash flow that's negative is a cost, so that you will add the negative cash flow today to it. The NPV rule says that what you do is you rank order them in terms of the net present value, that's the discounted value of the future cash flows, also called the intrinsic value of the project, minus the cost today, hence the net. You don't invest in those things that are negative. You invest in those that are positive. And if you're to rank order them, say you're only allowed to do one of these projects, then you rank order them in terms of the highest net gain over the cost, and the cost of borrowing is reflected by the discount rate. So with these projects, what I'm going to do is show you how to calculate net present value and show you how the rule works. So we'll basically run this with our calculator. So the net present value of A is actually quite simple. The net present value of A is equal to, oops, just a minute. There we go. It's equal to the discounted value of each of the future cash flows. Well, there's only one. The interest rate's 10%. It occurs in a year, so we'll discount it once. And let's see how that calculates out. This is simple enough. I'll just do it this way. $1,000 divided by 1 plus interest minus $1,000 cost, negative 90.91. I'll round it. So the NPV rule says don't invest. Now this makes sense because if I put that $1 million in the bank, I'll earn some interest on it. Why would I put the $1 million in A, take the risk, and end up only getting the $1 million back and no return on my investment? So NPV negative says don't invest in A. B and C are a little bit more complicated. What you're going to do is take each one of the cash flows, discount it back to today. So I'll do B first. At the interest rate, to the power of the number of periods that the cash flow occurs in the future. Minus the cost. Now this isn't too bad. The way I do this on a calculator, if I don't have a financial calculator, is take 1,000 divided by 1.1 once, starting with the cash flow here at year 5. That'll bring it back to year 4. I add the 1,000 that occurs at year 4, divide it by 1.1 one more time, bring it back to year 3. Then I add the cash flow in year 3, divide by 1.1. That's pretty easy to do. But your financial calculator is actually designed specifically for this kind of thing. If you use the cash flow button functions by pressing the cash flow button here. Cash flow 0 is the amount that this investment costs today. It's going to be negative. 2,000 negative, press the enter key. The little equal sign says you've got it entered. Press the down arrow. The first year's cash flow is 1,000. Enter. Now I'm going to enter each of these separately. Second cash flow is 1,000. Enter. You press the down arrow key here twice to get to the third cash flow. 4,000. Enter. Down arrow, down arrow. 1,000. Enter. Down arrow, and 1,000. Enter, down arrow. Now you can scroll through all of these just to make sure you have all the numbers entered correctly. Looks like I do. And the way you get the value is to press the net present value button. It asks you for the interest rate. It'll be 10 here. It takes it in percentage terms. Enter, down arrow, compute. Net present value here is 4,045. Rounding. So this is a good investment. It returns more over the life of the project than an investor would demand as a return on their investment. Enough more that it can cover the cost and the investor's demand a return and leave 4,045 left over today in net present value terms. Then we can do the same thing with C. The only difference with C is $5,000 here. I'm sorry, 5,500. In year 3. Well, almost all the cash flows are the same. So if we enter the cash flows here, the cash flow today is 3,000. I should put that down here. So I'll just enter that. Negative, of course. And 1,000, 1,000, 5,500, 1,000, 1,000. Net present value is still 10%. Compute the new present value with the new cash flows by pressing the compute key 4172. These are the numbers we use to make the decision. Never invest in A. If you're allowed to do both and they don't affect each other, both B and C are good investments. If you're only allowed to do one, maybe you can only get a license to recondition one area for a snack bar at Carver Hawkeye, then C is overall better than B. Now the terminology we use for that is independent projects or mutually exclusive projects. These are kind of the two extremes. Independent projects, the decision to make one, does not affect in any way the decision to undertake another. Mutually exclusive is if you do one project, you cannot do the other, either because of cash flow or regulatory reasons. So if we have an independent set of projects here, we do B and C, reject A. If we're mutually exclusive, C is the one that gives us the most overall value.